Good morning, everybody. Welcome to this rundown for global markets for the 21st of February. The question I want to explore in this edition is this just a pause before we get a breakdown in the markets, or are we going to continue a bit higher yet? The answer is still up in the air, to be honest, but let's have a look at the facts and the patterns and see where the probabilities are likely to sit. There's certainly a lot going on at the moment. An incredible amount of change in global markets. It's almost a day-by-day proposition in terms of how the sentiment fluctuates. So let's take a look at a couple of bigger picture perspectives first. And I think you always need to start there. If you just zero in on stocks or you zero in on what an index value is doing, then it's pretty misleading. So I think you need to always be able to put it in perspective. So the big question that everybody's discussing, I guess, at the moment is, will the recent double bottom that we had, will it complete? And markets will head higher, and that'll be the end of the correction period, or will that double bottom fail? My leaning is towards the fact that it may fail just because there are so many negative triggers out there. And in a couple of slides, I'm going to just go through a comparison between now and 2011 from a fundamental point of view, just looking at the facts and really leaving it to you to decide. But there's a fair amount of factual evidence that would suggest that the probability of the market going lower is probably greater than it going higher from here. The trend is down. There's no question about that. The trend is down. Most of the world's stock indices are more than 20% off their peak, which means that officially they're in bear markets. So I don't think anyone can argue at all that the trend is down. And the market character has changed. It's nothing like it was in 2011. And I've covered that every week for the last 6 months. So that shouldn't be any particular revelation to anybody. The other point I'd make, though, is that in a bear market, which is what we are in, if you want to put a label on it, there's no question about that, that support levels tend to fail. A lot of people look at support levels and think, well, that's going to hold. But in a downtrending market, then by definition, support levels fail because a downtrending market has lower highs and lower lows, and to form lower lows you must break support. So it's pretty simple when you look at it from that point of view. Now the market was short-term oversold. It rebounded very, very powerfully last week and is now short-term overbought. And as we'll see when we get to the charts, really could go either way in the very short term. But no one can really pick that at the moment. The market volatility is so extreme that it's just a day-by-day guessing game as to the very short term. And that's why traders and investors need to remain focused on a slightly broader picture where where the trends are. Now, look, my fundamental position is this. I'm fundamentally a bullish outlook kind of person. I take a positive view of most things, and over the long term, stock markets do go up. So it pays to have fundamentally a bullish outlook. And I went long early in 2009. They were the recommendations to members. And that included gold stocks, which we did extremely well out of. So fundamentally, I'm quite orientated towards jumping into markets when there's a lot of doom and gloom. I remained bullish through 2012 to 2015 when most commentators were not. And if you've been watching these videos for more than a year or two, then you'll know that was the case. There was a lot of people pointing to reasons why the stock market would go down, and I remained bullish throughout that period. So fundamentally, I do not like to take a negative stance. The key lesson that I've really learned over the last 5 years in particular is really to learn to trust the chart patterns. The herd will always be wrong at the extremes, there's no question. So to have an element of contrarianism in your character is certainly a very advantageous thing. And the second thing that I've learned is the art of keeping a very open mind. Yes, you can form an opinion based on what you see at the time, but if the circumstances change, then you need to be prepared to change your position basically immediately. And that's something that is quite difficult to reach that point, because human nature is, once you've taken a position, you've kind of staked your credibility on it, and there's a reluctance to change. But it's cultivating that art of having a completely open mind and being prepared to move your position instantly, I think is a huge plus. So that's fundamentally where I'm coming from. So I'm going to present some facts about the comparison between now and 2011, and quite frankly, it's negative. But I don't want you to get the impression that I'm joining the band of habitually bearish commentators that are falling over themselves at the moment to tell you that the sky's falling in and the world's about to end. I'm certainly not one of those. I'm just calling the facts as I see them. I'm keeping my mind as open as I possibly can. The facts are that the sentiment at the moment is very, very poor. There's no argument about that. You've just got to look at price charts. You've just got to look at sentiment surveys. It's poor. And the other fact is that money has flowed out of equity funds in America in 10 out of the last 11 weeks. Now, that is something that hasn't happened again since 2011, and then you've got to go back to 2008. So that's a pretty rare event, but that's what's happening at the moment. So people are pulling their money out of the stock market. US corporate profits, not exciting. The growth is pretty mild, but look, it's not a disaster, and it's hardly pointing to a recession. So a lot of people are looking at profits and saying that stocks are overvalued and running out all these various opinions. But the fact is that it's probably neutral to mildly okay is how you describe American reporting season. Central bank actions, I think, are one of the really big worries. The fact that we've now got Europe and Japan and several other European countries on negative interest rates is a big deal, and it's a huge admission of policy failure, in my view, on the part of central banks. And the other thing is that there's confusing messages flying left, right, and centre. You just got to look at the situation where you had the Fed, which after 10 years finally raised interest rates by 0.25%, still has a forward projection to 2018 of a further 12 interest rate rises. So that's out there in the public forum with what they call their dot plot chart. So they're pointing towards 12 rate increases over the next 2 years. And yet Janet Yellen comes out and gives some credibility to the fact that America might go to negative interest rates. I mean, it's just insane. And it's those confusing messages that are concerning me, because the stock market works on confidence, and this sort of stuff is hardly doing anything for confidence. However, despite all that, despite the poor sentiment, despite the corporate profits not being exciting, and despite the very confusing actions of central banks, it doesn't mean that a financial calamity is about to occur. We could have just another extended period of muddle through. And my position has been over the last several years is that I acknowledge that a financial calamity is probably inevitable, but I've also been saying that I didn't see it on the horizon for at least 2 to 3 years, and possibly 5, 10, or 20 years, because you just don't know how long central banks can keep this game going. So just because things are pretty crook doesn't mean that we're going to get a financial calamity. But I want to be clear that I think one is inevitable. It is just a matter of when. Now I want to look at the comparison to 2011, and hopefully this is just purely factual observations. There has been a massive amount of additional debt added around the world at all levels, private, corporate, government, and with really nothing to show for it. And only a small portion of that additional debt, something less than 20%, has actually gone into productive investments. The rest has gone on inflating asset values, shares and property, and financing lifestyle and all those sort of things. So that's a pretty bad situation. We've trebled the government central bank debt, yet central banks are still not making any progress in terms of economic growth. Deflation now is, I think anyone would acknowledge, is more of a risk now despite all the stimulus. So we've had this extraordinary levels of stimulus, yet we've now got Europe having to resort to negative interest rates, and quite likely in March are going to go into even more negative interest rates. So, it's hardly a win. Central bank credibility is definitely waning, and stock market pricing depends on confidence. A good part of the value of the stock market is about the confidence people hold in the future. And what the central banks have been doing is just really severely denting that confidence. The pricing of risk became an absolute nonsense. Again, this is a fact. High yield junk bonds were being bought, and the returns were just stupidly low for the risk. Companies that were at a high risk of default were able to sell their corporate bonds at returns of 5, 6, 7%, which is just insanely low. So that had to shift back to something a bit more normal. Commodity prices are substantially lower than in 2011. Everyone understands that. But I think what a lot of people aren't really acknowledging yet is the flow-on effect through the economic chain. If commodity prices are down, that's not just an issue for commodity producers themselves. It's all the suppliers to the commodity sector, and then all of that multiplier effect through the economic chain. And that's still really playing out because clearly there's no evidence that oil has found a bottom. There may be a bottom in iron ore, who knows? Time will tell. And we don't know yet whether base metals have found a base yet either. And the final one is that in 2011, China was the savior. China came in, they still had high growth rates, commodity prices rebounded very, very sharply because of what China was doing in terms of their infrastructure building. So China was regarded as the savior for the world, and everyone looked to China to get us out of the mess. Whereas you look now, people have been incredibly apprehensive about China now for the last couple of years. And the final one is that we've got these massive currency wars through negative interest rates, and that has to have a destabilizing effect. And no one really knows, it's never been done before, so no one knows where this is going to go. But I think one of the undisputed impacts is going to be that it will, because it makes people pull their money out of the cash market. And the theory is that it will cause that money to go into more productive investment. In reality, because people are losing confidence, I believe it's just going to drain liquidity from productive investments. There's just going to be less money and less credit to go around. So, that's a concern because no one really knows how this experiment is going to play out. Let's look at American stocks. So that's the backdrop. And I've tried to keep that as factual as I possibly could. The S&P ended up rising by 53 points for the week. No real surprise because the market had become so oversold. And last week's strength has improved many of the indicators, but it's still too early to tell. They still need to push up considerably further yet. It was a positive to see money rotating back into the more economically sensitive sectors, consumer spending, technology, transports were looking better last week. So that is a positive. However, as I said in the first point, a bit early to draw any conclusions yet. On the S&P, there's resistance at 1950 and then 2,000 points, but the trend is down, as we'll see, and another retest of the lows, I believe, will almost certainly lead to a breakdown. So let's jump in and have a look at the chart. And we'll start with the S&P on a daily chart. Now, I want to highlight two areas. First of all, I'll just pan back and you just take a a look at the bigger picture. If you look at the red 150-day moving average line, it has clearly rolled over and the price is now living below that line. So clearly there is a change of character. This is the 2011 period down here. You can see if you look at the orientation of the moving average and where the price was, there is a considerable change in character. There's no question about that. Now we had a double bottom form in this area here, and that was August and September of last year. And now we've had another double bottom form here in the last little bit, and that corresponds with the lows of October 2014. So you can see we've got lower highs, we've got lower lows. Yes, we've got a double bottom. Yes, we've rebounded fairly strongly from that, and it's possible we could rebound. So far, we've rebounded to the 50% retracement level. We could make it up to the 61.8, which is 1978. It's possible we might even tuck in underneath these lows here from December, which would be just under 2,000 points. But if you pan back, you've got to acknowledge that we're forming lower lows, lower highs. The moving averages are turning down. The price is below the moving average. This is a downtrend. There's just no other way to describe it. And you can see the very long-term trend line from the lows of 2008. And they're coming in on a rising trend line. If we do break this support level here, which I think is probably the higher probability, then we're looking at 1730-ish, with the possibility of going down to maybe 1600 or something of that nature. But at this stage, the RSI is sitting right in the middle. Market could go up, could go down in the short term. I really don't know. There's the monthly chart that I keep referring to because I think it's just a good long-term perspective. So it hasn't really changed much in the last week. Let's look at the VIX index. And the VIX, you can see there is an uptrend. There's no question there's an uptrend through here. So if we put a median line through there, we are trending up. We remain above 20, which is an elevated level. However, it's not a level that is at an extreme that you would expect to see a bottom form in. And that's one of the reasons why I think the probabilities are lying to the downside that the 1820 support level will break, because we just haven't reached the sort of level of fear in the market that normally marks a low. So that's why I think we're yet to see a final spike in the VIX, which would, of course, correspond to a breakdown in the indices. Now, just a quick look at the US dollar index, because that's obviously at the heart of things as well. The US dollar has been in a strong uptrend, you can see, for, well, basically since 2014. We're just now in a big sideways consolidation. We're sitting in the middle of it. The index is around the 96, high 96 area at the moment. Could ultimately find its way down to 93, but you'd have to say that the way things are looking, the longer term picture for the US dollar is probably higher. While I'm here, I'll just take a quick look at the Australian dollar. So we're still in downtrend. You can see the red moving average line is still trending down. The price is still below that. So we're still in downtrend. And the fundamentals, as long as commodities remain weak, then the Australian dollar is likely to head down into the 60s. And I'll just take a look at the ASX 200, and you can see we're trading in a channel, and the price is sitting slightly in the upper half of that channel. It's possible we could push up to 5,100 if the market remained positive for another week or two. But you've got to say, again, just put aside whatever fundamental bias that you have. You've got to say this is in downtrend, and that's all there is to it. And it's and we're going to fluctuate between the upper boundary and the lower boundary, and that's pretty much it. So I've talked about this, the Aussie dollar at 71.5. Aussie stocks were higher by 188 points for the week, but look, this is all just up and down noise within a trend channel that remains to the downside, and 46.50 is still my next target after a bit of a bounce. Gold was lower by $8 for the week, which is again understandable. It had two huge weeks up where gold gained more than $100. It's held the break of its downtrend, so it broke out of that downtrend. It's managed to hold it, which is a positive. And the other positive is that gold stocks are outperforming, and also at a company level, they're showing good cash flows. Particularly the Australian gold producers, where the Australian dollar gold price is really quite buoyant. So gold companies in Australia generating lots of good cash flow. Now, there is a need for a pause or a retracement. We've sort of had that a little bit last week. Whether it continues for another couple of weeks, I don't know, but I'm certainly warming to the possibility that gold is embarking on a new bull market. And if that's the case, it'll go for a couple of years, and it will probably go for quite a fair distance. So let's just take a quick look at gold, first of all, on a weekly chart. So you can see there we've broken the downtrend. The bigger picture, though, the moving average is still down. The price is still below it. So there's still plenty of work needs to be done at the big picture level, but at least it's broken that downtrend. And if we go to a daily chart, you can see that a little bit more clearly. And that's just something that hasn't happened for a while. Now, we had a bit of a pullback, and then it advanced again. But I want to show you the GDX index, which is the main gold miners index on a big picture level. So these are the lows for gold stocks in October of 2008. You can see that was a very important support level. It provided support for the GDX over here in 2014 on a couple of occasions. Support in March of 2015. We then broke down. We rallied back to test that support now became resistance. We fell away again. We formed some new lows. And now we've come back and we've managed to break it. And it's a really important level, which on the GDX sits at around $16.84. We've managed to break it. We've pulled back a little bit, and then a very strong day on Thursday, and kind of an indecisive day on Friday. So there certainly are positive signs in the gold market, no question about that. Copper firmed a little bit to $2.10, was really just the fact that the US dollar was lower, so it's still currency related. Crude oil was volatile. It's moving quite a lot, but still ended up finishing the week about where it started, around about 29. And of course, this consistent downtrend in oil, whilst a lot of people initially cheered it and said what a good thing it is because it's putting more money in consumers' pockets, is having a real domino effect on the wider economy and many stock sectors. There's crude oil over the last 3 months. It's dropped from 44, got to a low of 26, and it's just sitting around the 29 mark at the moment. This is a broader view over the last 12 months, down from 65 down to under 30. There's the spot copper chart, hasn't done very much. So just to wrap it up, the overall strategic approach, which I believe is the only way to deal with this market, is to work from the extremes of both price and sentiment. When price moves up to resistance levels and gets overbought, when sentiment becomes a bit more positive and people start talking positively about the market, that's when you should be selling out of long positions, and if you do short sell, then going short. And vice versa, when the market sells off hard, we get down to oversold conditions and sentiment is really bad and people are running around picking up pieces of sky that are falling. That's when you want to think about selectively doing a little bit of buying, but retain, don't assume that we're going to get some massive rally, because the dangers are to the downside. And to me, that is the only way to deal with this market. If you want to try and trade on a daily basis when markets are sitting in the middle of a range and they could go either way. It's just a 50-50 bet, and that's a gamble. You may as well go to the casino. I would also suggest not staying in a position for too long. If you get some profit, I wouldn't hang around too long trying to get more profit, because the chances are the market's going to reverse back over the top of you. I would certainly take steps to reduce the risk and the volatility in your portfolio. And there are a number of things that you can do. And members watching this video, of course, know what all those things are, and we're doing them. If you're outside the membership, then I think there's some valuable support that I could offer you in that respect. Valuations still matter, but at the moment they're being trumped by the trends, and you don't want to buy a stock or stay in a stock because the fundamentals justify it, because we've seen the fact that stocks that have reached attractive valuations can still then subsequently lose another 25 or 50% of their value, which seems completely irrational, but it can still happen. So ignore the chart patterns at your absolute peril is my overriding message. If from outside the membership, if you would like more information, there's a live session on in Perth, which is on tomorrow night. It's not too late to register. And there will be, for those not in Perth, I will be running something online. I haven't really finalised the details or the date on that yet, but that will be coming. So there's my contact details for anyone that wishes to get in touch with me. Again, as I've been saying all year, this volatility is both a danger and an incredible opportunity. If you know how to play the market from the extremes and you've got the courage to pull the trigger, this is a period of fantastic opportunity. So please don't go and run away and hide, because we've been starved of this sort of opportunity now for several years. This is the time to step up, but you need to know how to do it. That's it for this week. Cheers.